The dollar is king. Prince Charles ascended to the throne last week after the passing of his mother, Queen Elizabeth, at the age of 96. We lived in England for 4 years back in the early 90s, and both my wife and I became royalists. The Queen was a woman who, through her 70 years on the throne, certainly changed and transformed the monarchy, and did it for the better. Rest in peace, Her Majesty. In my weekend video last week, the strong dollar made a break in the week, and I titled the video, Breakout or Fake Out. What was decided this week was that it was indeed a breakout. Like Charles, the dollar is king, or remains the king as it has been in place for most of the 2022. The euro versus US dollar made a new low, a higher dollar, going back to September 2022, and is closing comfortably below the parity level at 0.9690. The pound versus US dollar traded to the lowest level since 1985, trading to a low of 1.08365. The pound is within 840 pips of the parity level for that currency pair. The Aussie versus US dollar and the New Zealand versus US dollar got hammered during the global pandemic shutdown in 2020, so they are not making decade lows, but they are nevertheless trading at the lowest levels since 2020 pandemic and making some significant breaks technically. The dollar versus Canada, also a mover during the pandemic shutdown, nevertheless moved above its 50% retracement of the range since 2020 high and traded to the highest level since June of 2020. The dollar versus Swiss and the dollar versus yen have different stories, although the dollar versus Swiss advanced smartly this week despite the Swiss National Bank's 75 basis point hike. It remains still below the May and June highs and even the July and early September highs as well. The dollar versus yen is dealing with currency intervention. I will speak to the technicals a little later in the video. In that portion, I will address, now that the dollar is king, what would tarnish the shiny crown from a technical perspective, at least in the short term. So what were some of the fundamentals that pushed the dollar higher this week? Well, the Fed out-hawked the hawks, is how CNBC's Leisman put it correctly after the rate decision this week, where the Fed did the expected 75 basis point hike for the third consecutive meeting, but earmarked another 125 basis points for the next 2 meetings of the year. That was higher than market expectations.
But this idea that they indeed will get, and the chair seems to support going to that high level, which, as I said earlier, he's out-hawked the hawks here relative to where the market was going into this. The Fed is above where the market is for next year and the year after that.
The Jackson Hole speech from Chair Powell was terse and to the point. This decision and the subsequent press conference also backed up that sentiment. The target rate for 2022 surged to 4.4% from 3.4% at the last dot plot in June. That speaks to the bias shift from the Fed. The Fed does not see lowering rates until 2024 in the dot plot. As a result, yields in the U.S. went higher. The 2-year yield went up 35 basis points from 3.87% to 4.25%. Does it have to go to the target of 4.4%? We will see. The 10-year moved from 3.45% to 3.69%, a gain of 24 basis points, as the yield curve moved more negative, with the 2-10-year spread moving to minus 52 basis point. My chart goes to 1988, and that level is the most negative for the spread, indicative that the Fed's hawkish stance will push the U.S. in a recession. Meanwhile, until then, the employment situation remains intact in the U.S. The weekly jobless claims data this week continued to drift back to the downside. Good news in the employment feeds the interest rate increases and also the dollar buying bias for the traders. The higher yields and unemployment dichotomy are driving the dollar, but so is what is happening in other countries. In the UK, the new Prime Minister Truss regime announced large tax cuts and other stimulus fiscal measures to counteract the expected surge in energy prices this winter and the impact on the economy. Meanwhile, the Bank of England at the same time hiked rates by 50 basis points this week, with dissenters pushing for 75 basis points as they look to attack the threat of inflationary expectations. One hand takes away while the other hand feeds. Such is the fiscal and monetary policy dilemma, and the pound suffered from it as investors liquidated everything from UK stocks to bonds and to the currency. The ECB is following the leaders as it braces for their winter is coming. The fear from Russia remains, and although inflation remains high, the prospects for lower growth are greater than they are in the US. Besides, summer tourist season is now over as well, which should not be a good thing for their economies. The Bank of Japan has gotten to the uncle point where they don't want to see a weaker yen anymore. So they are intervening and hoping that getting burnt creates more of a two-way street for traders, but it is hard to argue the central bank and interest rate fundamentals that favors the greenback over the Japanese yen. Here is the deal as I see it. The Fed is certainly in the driver's seat. U.S. yields are moving higher. So are other yields in other countries. There are other central banks following the lead on rates as well, like the ECB, the UK, Canada, Australia, New Zealand. However, the U.S. is driving from a position of more strength from employment, and that is the wild card in the Fed's hand now. Imagine if unemployment was higher. The Fed does not have to publicly chat about a soft landing anymore. Doing so just pops up the stocks, makes everyone happy, and increases spending, and forces up services and potentially goods inflation at the same time. Instead of trying to do that old job of, I'm doing my job and we're going to work toward a soft landing, the new job is inflation is the enemy. That's it. The stock and housing market rising all the time is the enemy too. It is time to take the pot off the burner for a while. The Fed secretly is liking the lower gas due to less demand. They are secretly liking other commodity prices coming down. They like that the housing is not going up 2, 4, 6% each month and is actually going down. They are secretly liking excess inventories for clothing, for at least it offsets some of the food inflation. They are secretly liking the higher dollar as it lowers inflation. They are secretly liking lower stocks. But if stocks start to move higher rapidly, they will do the Fed equivalent of the Bank of Japan intervention and throw some shade on our sunny days. The best way to get a soft landing is not to talk about doing it, but instead inflating inflation and not talking of a soft landing and letting the markets and the economy soften the landing. That is a hope. If unemployment moves higher from these low levels, so be it. Admittedly, all this could have been avoided if the Fed did not pour fuel on the fire for so long and then have to race like never before to get rates from near 0% to 3.25% where they currently are at. They are now into the new plan, the new normal, where the more headwinds, the better. So the dollar is king. Of course, just because you're a king does not mean that you might be on the throne forever. And corrections can be brutal too. So in the second half of this weekend video, I will take a look at the technicals that will be needed to take the tarnish off the king's crown. So sit tight and enjoy. Now that we know the fundamental story of why the dollar is king, what might need to happen next week for the dollar to lose some of its luster, to have that crown tarnished? Let's start by taking a look at the euro versus US dollar. This is a weekly chart of the pair, and if we go back to this area way over here on the left side of the chart, in June all the way through October of 2002, the price first moved up to this area, then broke ahead, moved to a high of 1.0125, and then came back down and formed a floor right here at the 0.9662 to 0.9708 area. You can see a number of different lows came through here, and that helped form that floor and push the price back up toward our high here at 10125 before moving a little bit down and breaking and moving to the upside. That break and move to the upside started the trend move all the way up to the high price of 1.6044 in 2008 before the market started to rotate back to the downside. Moving fast forward to this year. The price has been on a steady move to the downside here for this currency pair. We know all the fundamental reasons, and in trading this week we saw the price move down. And where did we stall? We stalled on Friday in the last few minutes of trading, or last few hours, I guess, back at the old swing level. So the low for the day and for the week came in at 0.9668. That's right just above the low of this swing area at 0.9662, but in between that level and the 0.9708 level. You can see that more closely on the hourly chart. Here's our 0.9662 level. Here's our 0.9708 level, and the market price is closing around the 0.9688 level in between those two levels. So guess what? What would tarnish the dollar versus king bullishness against the euro is if the price of the euro versus US dollar started to move back above the 97.08 level and move toward our 38.2% retracement of the move down from this high down to the low right there. Getting above that level, getting above the 50%, and then getting above this area right here where we had a swing low, swing low, swing low, swing low, and then final swing low before breaking to the downside in Friday's trade. This area right here is going to be key for the shorter term bullish or bearish bias for this currency pair. If the price next week is able to get above that level, that would increase the bullishness for the euro versus US dollar, decrease the dollar king idea, as the dollar would be getting weaker on the move to the upside here in the euro versus US dollar. So this is going to be our key level where the tarnish starts to come off of the crown of the US dollar, and we start to see a lower dollar start to potentially take hold, push the price even further up toward the falling 100-hour moving average. Until then, the dollar is king. We will be looking for this first this level at 0.9708 to hold resistance. If that can hold and we start to move lower, don't get in the way, folks. The trend is definitely to the downside, and we should see further downward momentum in the euro versus US dollar. Let's take a look at the sterling versus US dollar. This currency pair reached its lowest level since 1985 this week. Sharp move to the downside. On the daily chart, we moved below this trend line, which came in around the 113.26 just type level, and the market broke below that level and really didn't give up the selling until we started to until we reached the weekend. How about that? We reached a low of 108.36. The price is closing at 108.44, just off that levels. Thank goodness for the clock stopping and for the weekend to arrive, because who knows where the pound versus US dollar would be. We know the fundamental story behind it, the extra stimulus that the government's adding in the face of the Bank of England tightening by 50 basis points just the previous day is sort of confusing investors, and they're exiting not only the bonds but also stocks, and we're seeing them sell the sterling versus US dollar as a result. So lots of fundamental news for the sharp decline in the sterling versus US dollar. Let's take a look at the daily chart, and if we look at this chart and connect recent lows through here, we see that the 112 level is a key level, a level that was broken in trading on Friday. We held it on Wednesday, we held it on Thursday, but Friday we moved below that 112 level. That opened the door for further downside momentum. So that 112 level is going to be a level that if the price can move above, that would take some of the tarnish off the dollar and increase some of the bullishness for the sterling versus US dollar, which of course is a weaker trend for the US dollar. So getting above that level would be more bullish for the pound and bearish for the US dollar. Let's take a look at the hourly chart, see if there's anything closer that we might pay attention to. And if recall, the 112 level on the daily chart is a level that we need to get to and through. Well, there's another trend line here on the hourly chart that was broken through Friday's trade. We actually moved below it in the London session, then broke higher in the early New York session before moving back below that level and trending to the downside for that currency pair. Now, at the closing level right here, the trend line cuts across at the 1.10396. So that's less than the 1.12 level on the daily chart. So if the price should be able to get above that trend line, that old trend line, and stay above that level, that certainly would be more bearish. It also corresponds with the 38.2% retrace on the move down from Thursday's trade. So keep in mind the 110.40 level right here, and it's going to be moving lower. At getting above that level and the 38.2 at the 40 level would be something that would increase the bullish bias on the failed break in the sterling versus US dollar on the hourly chart. And then once we get above that level, traders will start to look toward the 112 level, which is the trend line off of the daily chart that would need to be broken. So that's the sterling versus US dollar. Otherwise, stay below those levels and the bears remain in control. Let's take a look at the dollar versus yen. And what we know about the dollar yen, I'm going to go to the hourly chart here, is that I'm going to earmark the 140 level to the 145 level as the range for this currency pair. We saw the dollar versus yen move higher here after the Bank of Japan kept rates unchanged, but the move to the upside was met by intervention by the Bank of Japan, and 500 or plus pips to the downside was the resulting move. That move to the downside took the price below the 100 and 200 hour moving averages, and we saw a pretty sharp rebound back to the upside here that found resistance against those levels. And lo and behold, on Friday we also saw resistance sellers against the 2 moving averages right through here. So there is something to say that this might be a new ceiling for that currency pair. But I'm looking at this area right here between 140 and 145 as our new trading range for the pair. Stay below the 100 and 200 hour moving average, more bearish. Move above this level and we could see a rotation back toward this old trend line right here. That would increase the bullish bias for the dollar versus yen. That level currently comes in around the 144.11, and again it's moving to the upside, so look for that underside of the trend line here to hold resistance against the 145 level, which was of course the high here. The high here had the break to the upside, the intervention. Bank of Japan didn't like that move to the upside, started to move to the downside, so I'm kind of looking for this area to be topside resistance, but watch this area for resistance ahead of that. On the downside, what would tarnish the dollar versus yen, keep the bears in play, would be a move below the swing area. Let's call it the 142 level on the downside, and then look for this area right here where you're at a swing low, swing low, swing low. Moved above and below it level in trading on Thursday, but found support ahead of this area on Friday at the lows. So moving below this level would increase the bearish bias for the dollar versus yen, and we should see further downside pressure that could take the price back toward the 140 level, toward this swing area between 139.85 and 140.20. That's going to be our support level for the dollar versus yen. Let's take a look at the dollar versus Swiss franc, and this currency pair, like the dollar versus yen, is off of the high levels. We had those highs going back in May, and then in June. In the month of July, we saw a lower high, and that lower high was this area was tested in early September here, and found sellers against that level. This area right here between the 98.71 and 98.91 level is defined by a swing high, swing high, swing low, swing high, swing high, swing low, swing high, and swing high. So a lot of swing levels in between this 98.71 and 98.90 level. If the dollar is going to keep its bullish bias, we would need to get above that level and push toward our parity level, and then toward the 1.00637 highs that we saw in the month of May and the month of June. If we stay below that level, on the downside, what would tarnish the dollar dollar is a move back below the 100-day moving average. Earlier this week, the market moved up to the 100-day moving average, found sellers, found sellers, found sellers, and then finally on Thursday we broke to the upside. So a move back below the 100-day moving average would tilt the bias more to the downside of traders looking for the 50% retracement of the move up from this 2020 or the end of December low right here, this trend move to the upside. So getting below the 50% retracement, and then we'll look toward the 95.44 level, and finally to the 200-day moving average. A couple weeks ago, the market came down, tested the 200-day moving average, found support buyers, and that's helped to start the move back to the upside for this currency pair. A move below the 100-day moving average would certainly weaken the US dollar versus the Swiss franc, take the tarnish off the US dollar against that currency pair. Let's take a look at the dollar versus Canada next. And on the weekly chart, if you go back to the 2020 high here to the 2021 low here, the 50% retracement cuts across at this 133.36 level. In trading this week, the price moved above that level, then started to take other levels on the top side, including the 133.83 level here and the 134.19 level. The 19 level is a September high. Here's the highs from also September. Here, the swing high right here, and this yellow area represents swing levels going all the way back to 2018. So this whole area between the close to the 50% retracement and 134.19 would need to be broken on the downside to start to hurt the bullish bias in the dollar versus Canada. On the top side, we have the 61.8% retracement coming in at the 136.50 level. If we move above that level, it would take the price toward the high price from 2018, which comes in at 136.64. So 136.50 is a 61.8. 136.64 is the high price going back to 2018. Get above that level would open the door for further momentum in the dollar versus Canada. What would take the tarnish off that currency pair is a move back into the, below these swing levels. First at 134.19, then 133.84, then the 50% retracement at 133.36 and 133.27, and finally getting back below this trend line here would also ruin the bullish bias in the dollar versus Canada. What we know about the dollar versus Canada is that it's gotten its strength here, not only from dollar buying, but also Canada selling. We saw oil prices move sharply to the downside this week, and that helped to weaken the loonie. The Aussie versus US dollar, I'm going to take a look at the weekly chart here, and if you notice these swing levels, one here, the swing low here, swing lows through here, swing low here, swing lows through here. This is before this, the March 2000 fall to the downside here off the pandemic. The price initially moved below that level in February through here, through this floor here, giving a bearish bias, and then we corrected up back into that swing area before falling sharply because of the pandemic, because of the shutdown, global shutdown, sent the price all the way down to the 55 level. We're currently trading near 65 up here, 0.6528. That's where the market closed out. I don't think we're on our way back to the 55 level. That was extraordinary circumstances there that sent the pair sharply to the downside. Dollar is stronger, but we do have additional support coming into play here at the 64.61 level. This week we did see the price move back below this swing area. Earlier in the month of July, the price came down and tested that level and moved up, tested the 200-week moving average here before rotating to the downside over the last 7 or 8 trading weeks. In trading last week, the swing area held support, and this week, as you can see, we fell below that level and moved sharply to the downside. Other things, levels of note here in this chart, the weekly chart in particular, is how the price moved up and tested the old 50% of this move to the upside and found sellers against that level. So what would take some of the tarnish off the dollar bullish development with the move to the downside in the Aussie is a move back above the 50% retracement as well as a swing area. Get above the swing level, get above the 50% retracement. That would increase the bullish bias for the Aussie versus US dollar, weaken the US dollar in the process. So pay attention to those levels. On the downside, the 61.8% retracement is the next target. That comes in at 64,615, move below that level. And we do open the door for further downside momentum in the Aussie versus US dollar. Finally, I'm going to take a look at the New Zealand versus US dollar. Again on the weekly chart, and if we go back to this area right here, swing low, swing low, swing low, swing low. Number of different, 4 different swing lows on the weekly chart. Those levels come between the 159.09 and 159.21 level, just about 10-12 pips right there. And in trading this week, the market fell below that swing area. Also, it corresponded with this trend line right here. So a dual reason why the market should go lower, and indeed we did see increased momentum to the downside. If we take a look at the hourly chart, this area right here is where that selling took place. As you can see on Tuesday's trade, market came down to the top of that area. This is again off the weekly chart. We fell below it, and we sort of sideways our way, but stayed below that level. The last gasp for the buyers was a failure right here against the low of that swing area near the 0.5995 level, and we saw the price then move to the downside and reestablish a resistance level against this trend line in trading on Thursday right here. In trading on Friday, we tried to move up to the trend line and fell down stayed below that level, and then fell below this old trend line right here. Now this old trend line was broken on Wednesday and into Thursday's trade, but then rebounded to the upside, test this trend line up here, came down, tested the old trend line right here before finally falling below the level on Friday. We did have a corrective move that came up, guess what, right to the underside of that trend line and moved to the downside. The low price came in at 0.5730. Again, that's the lowest levels going back to 2020, and we saw the market just stall at that level. So what would tarnish the New Zealand versus US dollar and the dollar, I guess the dollar bullishness, is if the price of this pair could get back above this trend line right here, back above the 38.2, back above this trend line right here. All those would give the New Zealand more bullishness, the dollar more weakness, and tarnish the dollar is king idea, and then getting above the 100-hour moving average would also tarnish that reputation of the dollar. As you can see, the price of the New Zealand versus US dollar has been below the 100-hour moving average and 200-hour moving average really since this day right here. This is September 13th. So trend move to the downside, staying below the moving average levels, staying below the trend lines, all keep the bias to the downside for this currency pair, and the US dollar the strongest versus the New Zealand dollar. So there you have it, a look at the major currencies versus the US dollar as we head into the new trading week. Certainly the dollar is king. There are levels, however, that would take some of the tarnish off that crown of the US dollar. I hope this video outlined those levels for you so that you can prepare and be ready for the new trading week. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.